After studying this module, you shall be able to understand the concept of venture capital, learn about the various financing instruments used by venture capital firms, identify different stages of funding, understand the funding process, analyze the factors that influence venture capital firms' choice of investment, understand the different exit strategies available to venture capitalists, learn about the SEBI provisions with regard to venture capital firms. A number of businesses fail because they cannot access to funds. To ensure that businesses have funds as and when required by them and they do not face untimely death, venture capital institutions or firms have emerged. No innovative ideas shall meet death in its womb, for genuine need for finance is the ideology on which the venture capital institutions thrive. The Indian economy has of late witnessed the growth of a number of venture capital institutions that cater to the financial needs of business organizations that involve high risk. Concept of venture capital. The term venture capital consists of two terms, ventures and capital. The term venture means to commence a risky course of action, the outcome of which is uncertain. Capital refers to wealth in the form of money or assets that is available to an organization or a person for starting a business or investing. Thus, venture capital implies commitment of funds to a business venture. It refers to money provided to a new business or a growing business by an outside investor. The outside investors, known as venture capitalists, provide funds to the business knowing that there is a high degree of risk associated with the cash flow and future profits of the business. The investment is made by venture capitalists in exchange for equity stakes in the business. Venture capitalists have long-term association with the business organizations and provide distinct type of funds that are appropriate with each stage of the organization's development. They generally provide startup finance to new and untried businesses that lack stable record of growth. The Journal of Central Bank UK defines venture capital as equity by which an investor supports an entrepreneurial talent with finance and business skills to exploit market opportunities and thus obtain long-term market gains. The venture capitalists do not just provide funds to entrepreneurs and businesses, but also provide the expertise in setting up a business, designing the marketing strategies, and organizing and managing the business. The venture capitalists join the businesses as co-promoters and lend the support through finance and superior managing skills so that opportunities in the market can be exploited effectively. Let us discuss the characteristics of venture capital. The venture capitalists generally provide funds to new and cutting-edge businesses in a sector where there is little historical data available. Estimating the probability of success of investment is often difficult as investments are made in nascent industries. The investment made by venture capitalists is long term. The funds need to be latched for a period of 5 to 10 years before disinvestment. Venture capitalists make investment through equity instruments. The return that a venture capitalist get from these investments is taxed as capital gain rather than ordinary income. The venture capitalists take part in the management of the firm. However, they are not involved in the day-to-day managerial aspects of the business. The investments made by venture capital institutions are highly liquid, highly illiquid. That is, the investment is not repayable on demand. Cashing out in the short term is not a benefit that can be enjoyed by venture capitalists. Looking at the financing instruments used by venture capital firm. The instruments used by venture capital firms to finance investment are as follows. 1. Equity. 2. Debt. 3. Quasi-equity instrument. Let us study each one of them in detail. The most common mode used by venture capitalists to fund assisted enterprises is through equity. They generally take a minority position in the equity of the enterprise they are funding. Equity refers to the risk capital that has been staked by the owners through purchase of company's stock. This money is not to be repaid in the normal course of business. Financing through equity gives the venture capital firms the right to appoint nominees on the board of directors. Moreover, they also have the right to conduct a concurrent audit and examine the books of accounts. The venture capitalists have the option to decide the timing of disinvestment by listing the shares on the stock exchange. Debt refers to an obligation that one party has towards second party. In simple words, it refers to the money that has been borrowed by one party from another. Venture capitalists as well as assisted enterprises do not prefer using debt as a financing instrument. It is normally provided by venture capitalists to fund short or medium-term requirements of enterprises and meet temporary cash shortages. Term loans, bonds, debentures, fully or partly convertible, are common debt instruments used by venture capitalists. Quasi-equity instruments. Quasi-equity instruments are debt instruments that have certain traits of equity, like being unsecured and flexible repayment options. Quasi-equity instruments generally contain a charge on the asset, royalty on sales above certain levels, and collaterals. Stages of funding. Traditionally, it was believed that the objective of venture capitalists was to finance relatively small but growing companies during their early stages. However, venture capital is a much broader term and is involved with funding different stages of development of an enterprise. Seed financing. In the first stage of venture capital financing, it refers to the funds provided to finance the initial development of a new product. Also be provided to test the feasibility of a project, conduct market research, develop the product, fund administrative setup costs, hiring the management team, and developing the business plan. The time scale of the investment ranges from 7 to 10 years and is the riskiest investment. What is startup finance? This stage is considered to be the essence of venture capital activity. Startup finance is required by those businesses that are in the process of being organized or are in the business for a very short period of time, but their product is not in the marketplace. Funds are required for the development of the product, establishment of product facilities, and initial marketing activities. The time scale of investment is generally 5 to 10 years and the risk factor is high. First stage finance. Businesses require first stage finance once they have utilized their initial capital in developing and test marketing a prototype and need funds to initiate the commercial manufacturing and sales of their products. The businesses have assembled a management team and a marketable product and have been in business for less than 3 years. The risk factor is high, but compared to the above stages, it is less. The time scale of investment is 4 to 6 years. Second stage financing. A number of venture capitalists are attracted to this stage of financing as compared to first stage of financing. This kind of funding is required by a growing business that requires additional funds for its expansion. They might need funds to enter new markets or to increase their marketing efforts. The risk factor is high and the time scale of investment ranges from 3 to 7 years. Third stage financing. Third stage financing, also known as development or expansion financing, is required by a business after it has established itself in the market. The funds are required to set up a proper distribution network and for financing capacity expansion so that the economies of scale can be attained. The amount of risk associated with such ventures is less, thus making it easier to get funds from venture capitalists. Venture capitalists invest a small proportion of their funds towards such businesses as a hedge against having all their investments in earlier stages. The time scale of investment ranges from 1 to 3 years. Bridge financing. This constitutes the last stage of funding by venture capitalists. The aim is to help the business go public and come out with an IPO so that the venture capitalists can exit venture with a profit that commensurate the amount of risk that has been borne by them. We must read about the stages of funding process. Let us now move to the different stages of funding process. It includes seed financing, startup finance, first stage finance, second stage financing, third stage financing, bridge financing. After studying about the stages of funding process, let us now go over the funding process. Looking at the funding process, different stages involved in funding process are submission of business plan, introductory meeting, due diligence, term sheets and funding. Let us study each one of these in detail with the help of visuals and graphics. Submission of business plan. The business that requires funds needs to first of all submit a business plan. A business plan should include a description about the opportunity, the market size that the project is likely to attract, a brief description about the management team, details about the competition and financial projections. Along with the business plan, the assisted enterprise also needs to submit an executive summary. The venture capitalists then discuss the opportunity internally and take a decision to proceed with the opportunity or not. Next is introductory meeting. If the assessed enterprise has the potential to fit with the venture capitalist preferences, the assessed enterprise will be called to discuss the opportunity in more depth. After the meeting, the venture capitalist will decide whether or not to move forward with the opportunity. Third one is due diligence. The nature of the business proposal will determine the duration of the due diligence phase. This period can last from 3 weeks to 3 months, during which the assisted enterprise will have to exchange information as and when required by the venture capitalists through phone calls, emails, management interviews, etc. And the last one is term sheets and funding. The venture capitalist will offer a term sheet once the due diligence phase is satisfactory. The term sheet is a non-binding, negotiable document that lays down the basic terms and conditions of the investment agreement that have to be agreed upon by all the parties to the agreement. After a period of 3 to 4 weeks and completion of all legal formalities, the funds are made available to the assisted enterprise. Let us now discuss about the factors influencing venture capital firms' choice of investment. The different factors are 1. Track record, 2. Relevant experience, 3. Risk profile, 4. Industry experience, 5. Commercial viability of the project, 6. Sustainable competitive advantage, 7. Strong management team, 8. Financial indicators, and 9. Marketing strategies. First is track record. The most important factor is the track record of the promoters and the management team. The venture capitalists analyze the track record of the promoters in their previous vocations. Second is relevant experience. Another important consideration that venture capitalists look for is whether the promoters of the business have had any experience in the proposed business. Third is risk profile. The assisted enterprise should meet the investment objectives in terms of the risk profile, return, and time horizon of the venture capitalists. Fourth is the industry experience. Venture capitalists generally prefer to invest in those industries in which they have knowledge and expertise so that they can provide the assisted enterprise with value-added services. Fifth is commercial viability of the project. The venture capitalists evaluate the project on the basis of its ability to generate revenue. They check whether the product or service can be reproduced efficiently as to generate sufficient revenue. Sixth is a sustainable competitive advantage. The venture capitalists want to fund an idea that is truly unique to the industry and will be difficult for others to imitate. The venture capitalists want an assessment of strengths and weaknesses of the competitors and some strategies to meet competition before they decide to fund an enterprise. Next is strong management team. The venture capitalists want to invest in venture that has a strong management team. The team's leadership should be able to inspire confidence amongst those who work for them. The management needs to have the vision, the expertise, and the capability to drive the business to a high level of growth. Eighth is financial indicators. The venture capitalists analyze the project cost and the financial projections for the next few years. They are also interested in knowing when the business will break even. Ninth is marketing strategies. Venture capitalists study the target market and analyze the strategies made by the enterprise to capture the market effectively. The market size and the growth potential of the market have an impact on the decision to fund a project. Let us study about venture capital firms' exit strategy. Venture capitalists require an exit strategy to realize a return on the investment made by them. It is the way through which they cash out their investment in a portfolio company. The time duration from investment to exit varies. It could be as little as 3 years to as long as 10 years. The exit options available to a venture capital firm are as follows: initial public offering, mergers and acquisitions, shares buyback, and sale to other investors or venture capital firms. Let us study each one of them in detail. First is initial public offering, that is IPO. It is the method through which the business offers the shares in the market for public to buy and sell. The flexibility offered in terms of price, quantity, and time by this option is the reason that this option is preferred by majority of venture capitalists. They can decide the price at which the shares will be sold and in what quantity depending upon the scenario in the market. Next is mergers and acquisitions. The venture capital firm has an option to sell the shares of the business partially or fully to another company. The venture capital firm does not have enough flexibility with regard to the quantity, price, and timing. The control that they have over exit through this method is very less as compared to IPO due to less flexibility. Third is shares buyback. The promoters or the owners of the business can repurchase the shares of the company from the venture capital firm on a fixed price after negotiations. This is the least favored exit option amongst the ventured capitalists. It is employed only when IPO and mergers and acquisition option is not available to them. Last is sale to other investors or venture capital firms. The venture capital firm may want to offload the shares held by them by selling the shares to angel investors or other venture capitalists that would be able to bring in more money for the business. Let us now study about SEBI provisions with regard to venture capital firms. A venture capital firm can be set up by a company or a trust after obtaining certificate of registration from SEBI. Once a firm receives the certificate, they are required to abide by the provisions of the SEBI Act 1992. Some of the important provisions have been listed below. A venture capital firm can raise money from any investor, India, non-resident Indian or foreign provided the money accepted is not less than 5 lakhs. The venture capital firm cannot issue any advertisement inviting offers from the public for subscription of its security or units. SEBI regulations permit investment by venture capital firms in equity or equity-related instruments of unlisted companies and also in financially weak and sick industries whose shares are listed or unlisted. All investment made or to be made by a venture capital fund shall be subject to the following conditions, namely A. Venture capital fund shall disclose the investment strategy at the time of application for registration. B. Venture capital fund shall not invest more than 25% of the corpus of the fund in one venture capital undertaking. C. Shall not invest in the associated companies. D. Venture capital fund shall make investment in the venture capital undertaking as enumerated below. 1. At least 75% of the investable fund shall be invested in unlisted equity shares or equity linked instruments. 2. Not more than 25% of the investable funds may be invested by way of a subscription to initial public offer of a venture capital undertaking whose shares are proposed to be listed subject to lock-in period of 1 year. B. Debt or debt instrument of a venture capital undertaking in which the venture capital fund has already made an investment by way of equity. All investments made or to be made by venture capital fund shall be subject to the following restrictions. A. The venture capital fund shall not invest in the equity shares of any company or institution providing financial services. B. At least 80% of the funds raised by venture capital fund shall be invested 1. In the equity shares or equity related securities issued by a company whose securities are not listed on any recognized stock exchange, provided that a venture capital fund may invest in equity shares or equity related securities of a company whose securities are to be listed or are listed where the venture capital fund has made these investments through private placements prior to the listing of the securities. 2. The equity shares or equity related securities of a financially weak company or a sick industrial company whose securities may or may not be listed on any recognized stock exchange. For the purpose of this regulation, a financially weak company means a company which has at the end of the previous financial year accumulated losses which has resulted in erosion of more than 50% but less than 100% of its net worth as at the beginning of the previous financial year. Third, providing financial assistance in any other manner to companies in whose equity shares the venture capital fund has invested under subclause 1 or subclause 2 as the case may be. For the purpose of this regulation, funds raised means the actual money raised from investors for subscribing to the securities of the venture capital fund and includes monies raised from the author of the trust in case of venture capital fund has been established as a trust, but shall not include the paid up capital of the trustee company, if any. Every venture capital fund shall maintain for a period of 8 years books of accounts, records and documents which shall give a true and fair picture of the state of affairs of the venture capital fund. Also, every venture capital fund shall intimate the board in writing the place where the books, records and documents etc. are being maintained. Let us summarize what we learned in this module. The venture capital fund provides funds to risky businesses in return for equity. The venture capitalists do not just provide funds to a business but also take part in the management of the firm. The investments made by venture capital institutions are highly illiquid. That is, the investment is not repayable on demand. Equity, debt, and quasi-equity instruments are used by venture capitalists to finance ventures. The different stages of funding are seed financing, startup finance, first stage financing, second stage financing, third stage financing, and bridge financing. There are 4 stages involved in the funding process: submission of business plan, introductory meeting, due diligence, term sheet, and funding. Track record, relevant experience, risk profile, management team, financial projections, and marketing strategy are some of the factors that influence venture capitalists' choice of investment. IPO, merger and acquisitions, shares buyback, and sale to other venture capitalists are the exit strategies available to venture capital firms. A venture capital firm can be set up by a company or a trust after obtaining certificate of registration from SEBI. The different stages of funding are seed financing, startup finance, first stage financing, second stage financing, third stage financing, and bridge financing. There are 4 stages involved in the funding process: submission of business plan, introductory meeting, due diligence, term sheet, and funding. Track record, relevant experience, risk profile, management team, financial projections, and marketing strategy are some of the factors that influence venture capitalists' choice of investment. IPO, merger and acquisition, shares buyback, and sale to another venture capitalist are the exit strategies available to venture capital firms. A venture capital firm can be set up by a company or a trust after obtaining certificate of registration from SEBI.